Welcome to the deep dive. Today, we're turning our attention to the gold market. It's definitely been screaming headlines, hasn't it?
Absolutely. Trying to break new price barriers, but, well, hitting some resistance too.
Exactly. And our mission here is, well, pretty straightforward. We want to cut through the noise. We've got this comprehensive four-quarter preview we've analyzed.
Right. One that maps out the bullish case for gold, but also weighs it against the immediate technical risks.
It's a classic setup, really. Short-term caution versus this massive fundamental conviction.
Definitely.
And right now, the immediate picture looks, well, tense. The rally seems capped.
Yeah.
Stuck around $3,900 for a few days now.
Stuck is a good word for it.
But, the big money, they're not just looking at those daily charts, are they? We've got a serious analyst predicting a huge target.
Yeah, that's the headline grabber, $4,000 an ounce, maybe by year end, certainly looking towards the end of 2025.
So that's our focus today. We really need to unpack this prediction. It seems kind of extraordinary, right?
It does. If gold's struggling right now, how can an analyst stick to such an ambitious target? We have to understand both sides.
The technical risks.
Exactly. The indicators flashing red. But also, and maybe more importantly, the powerful underlying fundamentals. The stuff driving this whole historic run.
The things giving this analyst, Fawad Razakzada, such confidence.
Precisely.
Okay, so let's start with momentum. Before we get bogged down in the risks, we have to appreciate the scale of this move. Just how big a year is this for gold, historically?
Oh, it's not just a good year. It's genuinely historic. The source material points out gold has already surged over 40% year to date.
40%.
Yeah, 40. And if it keeps up anything like that pace, it'll be its best single annual performance since, get this, 1979.
Wow, 1979. That really puts it in perspective.
It does. That comparison alone tells you we're not in some typical cycle. This momentum, it speaks to immense buying pressure under the surface.
Okay, 40% is staggering. But you mentioned tension earlier. Where's the immediate conflict, especially for, traders watching the charts second by second?
The conflict is, well, purely technical right now. While the long-term outlook seems incredibly strong, the charts themselves are screaming caution.
How so?
Razakzada, the analyst, states it very clearly. He says the metal is extremely overbought.
Ah.
And that's the friction point, isn't it? You've got this analyst projecting $4,000, but at the same time, the technical indicators, the ones usually reserved for predicting major corrections, they're flashing bright red.
Right. That's a genuine contradiction. And this is where the analysis gets really interesting, I think, because usually you hear extremely overbought and everyone expects a crash, right?
That's the standard interpretation, yeah, if you just look at the headlines or basic chart analysis.
So why isn't this analyst calling for a massive pullback?
That's the key question, and it highlights why context is so important. You can't just look at one indicator in isolation. Razakzada tackles this paradox head-on. He acknowledges, yes, the overbought signals are flashing, but then he points out that the actual price action, what the market is doing, remains resolutely bullish.
So the price keeps going up despite the warnings.
Essentially, yes.
Yeah.
The insight here is that when the underlying trend, the fundamental money flow, is this strong, historically strong, these traditional technical signals almost change their meaning.
How do they change?
Well, they stop acting as predictors of a reversal, like they normally would, and instead they start acting as confirmation of extreme strength.
Confirmation, that sounds counterintuitive.
It does, but think of it like this. They're basically saying the trend is moving with such force that the normal measures of momentum can't keep up. They're breaking down. It confirms the market is just very strong, not necessarily that it's about to collapse.
Okay, so it's a sign that money is rushing in faster than the charts expected.
Precisely. It reframes the whole technical picture.
Yeah.
What looks like a weakness signal is actually interpreted as a strength signal in this specific context.
That's fascinating. So what does this mean for, a practical strategy? If we assume this incredibly strong trend holds, what's the advice?
Well, the core tactical advice, according to the analysis, it hasn't really changed despite these extreme readings. The strategy is pretty straightforward for a bull market this strong.
Which is?
If there's a dip, you buy it. Simple as that. Until, and this is key, until what he calls a fan reversal pattern actually shows up on the price chart itself.
Not just on the indicators.
Exactly. Not just the RSI or whatever indicator being high. You need to see the price action itself break down. Until then, any retreat is viewed as just an opportunity to get in or add.
Okay, that makes sense. For those of us, tracking this closely, we need the specifics, the technical guardrails. If the market does pull back from this $3,900 resistance, what are the key support levels? Where does it need to hold?
Right, critical question. The analysis lays out three main levels, or zones, to watch sequentially. First, you have some minor support areas. Think $3,700 and $3,600.
Okay, minor stops.
Yeah, likely spots for some minor profit-taking, that sort of thing. But the first major robust support level to really keep an eye on is $3,500 per ounce.
3,500. That's the first big test.
That's the psychological and structural floor that really needs to hold to keep this immediate bullish narrative intact.
And what about deeper? The levels that would make even the bulls start sweating? The real lines in the sand?
Good question. There are two areas below $3,500 that are fundamentally important according to this analysis. First, keep a close eye on $3,435.
Why that specific number?
It's highly relevant because it marks the base of the entire third quarter breakthrough. When gold smashed through that level, it really kicked off the last major aggressive leg of this rally.
Okay, so breaking back below it would be bad news.
Very bad news. Slipping below $3,435 would wipe out that crucial structural gain. It would definitely make the bears feel a lot more confident.
And the absolute final line, the point of no return for this current bull market structure.
The analysis points to $3,300. That's the ultimate main line in the sand.
And the logic for $3,300.
It represents the last major low point before this whole current historical bull market really took off.
Yeah.
Breaking $3,300 would signal that the market structure itself has fundamentally changed.
Meaning the big picture has shifted.
Yeah, meaning either the fundamental forces have changed, or maybe the technical exhaustion, the overbought condition, has finally won out after all.
That's a really clear breakdown of the risk levels. Thanks. But as you hinted, this rally isn't just chart patterns or speculation, is it?
Not at all.
The analyst stresses it's driven by deep structural fundamental changes. What are these powerful forces creating what he calls an almost perfect environment for gold to thrive?
Right. Connecting to the bigger picture, the analysis boils it down to three core interconnected elements driving gold demand right now.
Okay, what are they?
Number one, sustained weakness in the U.S. dollar. Number two, incredibly strong buying from central banks globally. And number three, expectations of accommodating monetary policy from the Federal Reserve.
Let's dig into the dollar first, because the analysis links its performance to some major global shifts. Just how bad has the dollar's performance been?
It's been genuinely alarming if you're a dollar bull. The analyst highlights that gold is getting a continuous boost from the dollar's sustained weakness. We're talking its worst performance in over 2 decades.
2 decades?
Yep. The dollar index, the DXY, it had already fallen by about 10% by the end of September.
10% is a huge move for a major currency index.
It really is.
Yeah.
And to give you that historical context again, if the DXY finishes the year around these levels, it marks the weakest performance against its major rival since 2003.
Wow.
And back then, in 2003, the DXY dropped nearly 15%. So this isn't just a blip. It's a massive, sustained structural tailwind for gold, especially since gold is priced in dollars globally.
So why? Why is the dollar suffering such a beating? It can't just be interest rate expectations alone, can it?
No, the analysis points to deeper causes. Two main drivers are cited. First is macroeconomic. There are growing fears of stagflation.
Slow growth and high inflation.
Exactly. Linked primarily to the ongoing effects of, international trade tensions, tariffs, that sort of uncertainty. That naturally pushes investors towards safe havens and inflation hedges, like gold.
Makes sense. And the second driver?
The second one is maybe even more significant for the long term. It's this broadening perception, this narrative that America's economic dominance is, increasingly under threat.
And that ties into...
That leads directly into the whole concept of de-dollarization.
Right. We hear that term de-dollarization thrown around a lot. How is it actually impacting capital flows right now, according to this analysis?
Well, the analysis confirms it's not just talk anymore. The trend of de-dollarization is apparently gaining real momentum. It's translating into actual action.
Like what?
Like foreign investors, central banks, sovereign wealth funds, actively diversifying their holdings away from traditional U.S. assets.
Specifically away from treasuries.
Treasuries, yes, and dollar-denominated assets more broadly. When foreign central banks start aggressively shifting reserves out of the dollar and into other assets, particularly safe havens like gold, it creates this persistent, high-level demand floor for the metal.
A demand floor that speculative traders can't easily break.
Exactly. It's arguably the strongest fundamental pillar supporting that $4,000 target. this quiet, massive shift in global reserves.
Okay, that's a powerful structural tide. So if that's one engine driving gold, how does the Fed fit in? The expected accommodating monetary policy.
That acts as a massive accelerant on top of the weak dollar trend. It's the third pillar supporting gold, this anticipation of a renewed easing cycle from the Fed.
So rate cuts.
Rate cuts, yeah. Any easing action like that puts even more downward pressure on the U.S. dollar.
Right.
And that helps gold in two ways, remember. One, it makes the dollar weaker, so gold becomes cheaper for buyers using other currencies. And two, it reduces the opportunity cost of holding gold. Gold doesn't pay interest, right? So when interest rates on dollar assets fall, holding non-yielding gold becomes relatively more attractive.
Makes perfect sense. What are the markets actually expecting right now, timing-wise, for this Fed easing?
Well, based on the current data points, markets are pricing in at least one interest rate cut before the end of this year.
Okay, at least one.
But the analysis adds an interesting little wrinkle, linked to potential political instability. Some economists are suggesting that if, for example, there was a protracted government shutdown,
If Congress couldn't agree on funding.
right, that kind of event could potentially force the Fed's hand,
Yeah.
force them towards aggressive monetary easing just to stabilize markets.
And aggressive easing would be
An additional massive boon for gold prices, like pouring gasoline on the fire.
understood. Okay, so we've taken a pretty comprehensive deep dive into this preview. We've hit the $4,000 forecast, unpacked that counterintuitive overbought signal meaning strength, not weakness.
Right. And crucially, looked at the powerful fundamental drivers. The weak dollar, that massive central bank buying, and the Fed's expected easing.
It paints a picture of a market really caught between two forces, doesn't it? Short-term technical exhaustion versus these huge, long-term fundamental tailwinds.
Absolutely. And the key takeaway, the core argument from this analyst, is that the fundamentals, especially that structural shift away from the dollar, are just overwhelming the short-term technical warnings for now.
So the trend remains exceptionally strong.
And dips are seen as buying opportunities, at least until the price action itself tells a different story.
Indeed. Okay, well, we'll leave you, our listeners, with a final thought to maybe explore on your own. If this gold rally is fundamentally sustained, not just by temporary fear, but by this deep momentum of de-dollarization and a perceived long-term challenge to U.S. economic dominance, what broader strategic implications does that trend have, thinking about global asset allocation, the future stability of reserve currencies, maybe over the next decade or more?
A big question to ponder.
It is. That knowledge is now yours to apply.